Tunisia's parliament has approved the central bank's request to grant its treasury 7 billion dinars, or approximately $2.25 billion, to help plug a 10 billion dinar or approximately $3.2 billion budget deficit. The interest-free bond is repayable over a period of 10 years, including 3 years of grace, and will help finance part of the state budget deficit for 2024.
The exceptional authorization will allow the government to mobilize the necessary funds to cover the urgent financial needs of the state, especially repaying foreign debt. The government says Tunisia has no alternative to provide the funds and promises that resorting to direct funding from the central bank will not happen again. MPs are concerned about the impact of this measure on inflation and the depreciation of the dinar.
Experts have warned that borrowing billions from the central bank to plug budget deficits could cause inflation and shortages of essential goods.
This move is acceptable only in case the money is used for investment and not to repay debt and state expenses. Otherwise, it will cause forex scarcity. Borrowing around $2.25 billion is equivalent to 32 days of import. It will be at the expense of importing basic food products and raw materials. It will lead to high inflation and economic slowdown.
A few days before the adoption of the request to the central bank, the finance minister affirmed Tunisia's commitment to continue with the self-reliance approach in order to honor its domestic and international commitments.
Despite all the difficulties, especially the access to foreign funding, we have been able to respect all our commitments. We continue to prove our resilience capability. We have tried as much as possible to cope with the requirements of this difficult phase. Our slogan is relying on our own resources and strengthening efforts to provide resources to the state fund.
The unprecedented step of borrowing from the central bank comes as Tunisia finds itself unable to borrow from its traditional creditors, including the International Monetary Fund, whose proposed $1.9 billion bailout remains in limbo. Although the IMF has said that buying securities such as bonds can sometimes serve a monetary policy purpose, the Washington-based lender has warned countries that central banks should not finance government spending. Adnan Shawishi, CGTN, Tunis.